Hi, everyone. Good morning, good afternoon. We're ready to get started. Thanks, everyone, for joining. My name is Kevin McPartland. I am the head of research for the market structure and technology team at Greenwich Associates. We're really excited for this conversation today that we've titled The Latest in Fixed Income Trading Systems. We have a fantastic set of panelists, both sort of developers of and users of these technologies. So we really should be able to get into the weeds and understand sort of what's out there today and how it works. We are happy to have Dwayne Middleton from T. Rowe, Jeremy Kohler from AQR, and Anil Jaglan from Adroit Trading Technologies. So before we get started with the discussion, I need to cover a couple of housekeeping items quickly. If you're hearing an echo, please check your audio and make sure telephone is selected or computer audio if you're going through the computer. If you have additional questions during the webinar, please do submit them through the Q&A box. We will try to get to as many as we can. We'll try to answer some as we go. We'll also save some time at the end to answer some questions. If we don't get to your question, we will try to respond after. At the end of the event, you'll be asked to participate in a brief survey to let us know what you liked, what you didn't like, what you think we should do next time. So please take the time to do that. We very much do look at those comments. And finally, the webinar is being recorded, and the link will be sent out to all attendees in the next day or two, so keep an eye on that. And so with that all said, why don't we get started? So it's been a crazy year. I won't spend any time on that. I'm sure you've all been at plenty of webinars to talk about what's gone on so far in 2020, but I think it would be really a good sort of starting point to understand sort of what the trading workflow looks like today in fixed income markets, right? From receiving an order, trading it, and then sort of post-trade, and then sort of all the data and risk management that goes on that leads to the next order. And then what systems you use to help do all that. So Dwayne, if it's all right, we'll start with you. Maybe talk us a little bit through sort of what that workflow looks like. And then we'll hear from Jeremy.
Yeah, sure. I mean, I think our workflow is probably pretty similar to other institutional asset managers of our size. We have kind of a three-legged approach to our investment process with portfolio managers, research analysts, and traders, and we're all trying to use kind of the same data to help us make decisions. So really, we want data to kind of hit prior to the order generation stage, almost at the idea, discussion stage. So there's, usually a discussion, amongst the investment team members, of the three groups I just mentioned, prior to an order even being generated. So we really want to see, is that order executable in the marketplace, and can we execute it to, hit our alpha targets? We currently use an order management system, or OMS, to generate the orders, check compliance, assess the risk metrics of security, the security master is set up through there. And we have some currently we have some internal applications which we overlay on top of the OMS to, maybe get more specific and bring in the research perspective, or, run different analytics. We work closely with a quantitative fixed income team to assess risk opportunities as well. We're in the early stages of evaluating bringing on an EMS, vendor to, kind of be that connectivity point. Because I think one of the issues that asset managers struggle with is just the abundance of data, but also narrowing that data down so you can tailor it to your, specific trading style, your specific investment process. So that's really kind of the game plan. So, I'll end with the goal is kind of to streamline, aggregate, and automate where we can, and we believe that our future state is probably combining an OMS EMS solution for our investment process.
Great. And it sounds like the trading desk really does play a big part in the investment decisions of the portfolio managers, making sure what they want to do actually can be done.
I mean, in today's fixed income markets, I think the role of the execution trader is kind of well behind us. So, that trader has to view themselves as an investor and has to be a contributing member of that investment process, to help the investment teams, generate the, returns for clients in these very challenging markets.
That's great. Thanks, Dwayne. So Dwayne, with the asset management view, I mean, Jeremy, obviously AQR, hedge funds. What does your process look like, and sort of how's that workflow? Is it any different?
Right, a lot of similarities there. We are a combination asset manager and hedge fund, but at the end of the day, it's very similar to what Dwayne had talked about. A portfolio management team does create the orders. We have a proprietary OMS that basically we use across many different asset classes, not just over-the-counter fixed income, but broadly speaking. And from there, it's a spider web of services and checkpoints that an order goes through from a compliance standpoint, and there's some other overlay activity that we look at to sort of inject smarts into the process, if you will. But from there, we actually do use an execution management system that we've been working with Adroit on, actually. And, what's really key for us is really making sure that, the execution management system provides scale and stability, as well as really a sort of a central point to actually collect data. Obviously, we're trading a lot of, more legacy positions using more legacy flows, such as just voice trading over a period of multiple days or weeks. But we really think about the EMS as a place that can be agile and really provide support for exercising craftsmanship around how we organize workflows, how we make our trading desk more efficient. We want our traders' time to be used valuably, and with the onset of electronic credit trading and electronic trading in general, we really want to use the EMS sort of as an autopilot, if you will, to really provide kind of that assistant to how traders manage their time. To Dwayne's point, I would reinforce it. It's so important that the trading desk is a part of the continuous feedback loop with portfolio management and the whole investment management process, the whole front office. So we'll talk more about this, but we really spend a lot of time measuring everything we do, and that measurement, that aggregation of data, is something that every part of the investment process uses.
That's great. Yeah, and I think that link between the sort of the PMs and the traders is an important, change over the past decade, right? That's had a big positive impact. The other thing, Jeremy, that I picked up on is, and I'm sure there's not one single answer to this, but you said your OMS is internal. You've obviously looked outside for your EMS. Can you talk us through a little bit, maybe why that is, or how that came to be, and if that thought process is changing a bit in terms of buy versus build?
Sure. I mean, I think it just comes down to, how an organization is set up and what kind of scale they want. We think about an order management system as sort of something that can be layered across a lot of different asset classes. And, when it comes to sort of a fixed income, cockpit, if you will, in reference to one of your papers, we really think about, we really want to invest in innovation in the EMS, and we want to really be thoughtful about preserving market structure in order to actually layer on analytics. So, we need flexibility, we need robustness, and we need agility. And as I'm sure we'll talk about, we don't have all the answers right now. So we need to be prepared to have a platform that we can change over time depending on how the trading desk evolves.
That's great. So Anil, I'm going to bring it over to you. So Dwayne and Jeremy both talked about EMSs a bit. It is still a really new concept in fixed income. It's certainly not new in equities, right? At least since the 90s, we've talked about execution management systems in equities. But what is this? So how should we think about EMSs in fixed income? Sort of what is their primary purpose? And what do they do? How have what's it been like trying to build out that technology?
Yeah, so EMSs, vendor EMSs are new in fixed income, and in-house systems existed, and they are very different from equities because they have to be. So one is because the nature of the market, like the OTC trading versus the listed, and millions of bonds out there. So that's the basics. But the big reason is the users of fixed income EMSs are way more skilled, and the impact their actions have is much bigger. So for example, a fixed income trader is a half portfolio manager, half quant, and full-time trader. And we talked about it, that these three pillars have to work together, but like they are in the same room. And, their decisions, like, picking which bond to go trade, which dealer to pick, which protocol to trade on. And so like has a big impact on the, the bottom line, because transaction costs matter a whole lot in there. So it's like mostly like, you are dealing with like very sophisticated users, and the decisions that EMS have to make is a lot of complicated decisions. So that's where it gets, it has to be sophisticated.
Have you, as you've been building this out and you work with customers, do you feel like, and then we can take this back to Jeremy and Dwayne as well, do you feel like there are any notable differences between the needs of asset managers as opposed to hedge funds?
Yeah, so I think the big difference is that, like, asset managers have to deal with like, hundreds of funds. And so to combine them together, block trade them, so you get into like, fair allocation, min trade sizes, like, can I net against this account or not? Can I block it together? And then, then you have to be, because you're a fiduciary, you have to be fair to all accounts. And you say, okay, if I traded, who gets the first fill? If I couldn't complete the trade, who doesn't get it? And so all those things have to be dealt with. And, it's a very deep, involved topic. And we wrote a paper on it, about a white paper on it, to say, like, how do you pragmatically deal with it? Because it's very complicated.
Yeah, that's interesting. And I guess the line though still is blurring, right? As you have a firm like AQR who has so many different account types and I'm sure has more and more funds. And then on the flip side, right, T. Rowe, I'm sure is doing a lot more quantitative or quantamental type investing strategies, right? So I don't know, is there still much of it, like, is there still much of a difference, or do you both feel like it's, you're sort of melding into the other's model a little bit?
For us, they actually meld. I mean, I think there's a couple considerations that come to mind here. Certainly you have compliance considerations that are going to be different between a hedge fund and an asset manager to some extent. Scale, which Anil pointed out to, I think is important, how many different accounts. I think there's a spectrum in terms of how you think about trader discretion that can come into play in something like this. And that's something, we always want to be thoughtful about, so that, we can be responsive in the market, right? I mean, as we talked about before, I mean, traders have a bigger role to play in many cases with portfolio management. We have to be able to actually respond quickly to certain situations. And then, the duration of orders as well, I mean, is something we have to be mindful of, right? That's not always the same across asset classes. So those are some key considerations that come to mind for differentiation.
And I think one of the changes within broader fixed income, institutional asset management has been this concept of a portfolio solutions type approach. So we have a number of clients that are looking for solutions to hit their internal return objectives, and that is more of a portfolio attribute or security level attribute, as opposed to just looking at a single CUSIP, which a lot of the OMS were developed on single CUSIP constructs. So I think looking at having a conversation with a portfolio manager in terms of they might send us attributes. So we're looking for 7 to 10 year triple Bs, for example, and having an aggregated view of that liquidity to source those particular securities that meet those return objectives, I think is a very efficient pathway for trading going forward.
Right. It's less about a specific security and more about a type of exposure or a certain duration that you're looking for, right? And have the system help you find that. The other obvious difference, right? With fixed income, we talk about as one thing, but obviously it's not, right? It's depending on how you slice it up, right? It could be dozens of different markets with their own microstructures. So how do you deal with that sort of in building or using an EMS? If we think about, for instance, like US corporate bonds compared to convertible bonds, sort of related but different. So how have you, I guess whoever wants to jump in first, but sort of how do you manage that? And then how does the role of the EMS change sort of based on the individual products?
Well, from my standpoint, I mean, I think it's about, again, back to building in flexibility within your EMS, and that maybe that might not be quite as easy to do if you use one OMS across a firm. But for us, we want to build in agility. We want to be able to. I think that the key thing for us is from start to finish, we want to preserve, you know, for execution purposes and analytics purposes, we want to preserve how we think about market structure. We want to measure it and trade it in a consistent way. And so, you know, when you have derivatives and derivatives versus cash, or you have, you know, something like converts, I mean, all of this these all have different nuances. I mean, converts are, you know, in the true sense of the word, sort of the pinnacle of the multi-legged asset class, right? And if you can preserve, you know, how you think about trading that risk and how you think about managing delta within those trades, you know, for us, we think it's very value added for how we think about capacity and returns and implementation shortfalls. So we really want to lean on an EMS because we think it's the, you know, for us, it's the right place to aggregate the information and leverage that and pass it along throughout the organization. So investment grade corporates are a pairs trade, right? Typically, in many ways, and we want to measure how we do with a consistent approach.
I mean, you know, if you look at the municipal bond sector or securitized, for example, you know, very fragmented information. You know, different securities have different setups. It's you know, there are, you know, thousands of CUSIPs in both areas. The flexibility of an EMS from a connectivity standpoint. So, you know, one of the big themes in the market now is direct dealer connectivity. I view that less than a click to trade basis, but more on it like click to engage. So if we can get connectivity with dealers, you know, in those particular, you know, sectors which are, you know, less electronic trading, that could be a high level engagement. And, you know, the EMS is a natural, I mean, that's kind of what they do, is put the plumbing in for the connectivity. So I think that's a natural place to, you know, for any asset manager to leverage their relationship with key dealers from a connectivity standpoint. And, you know, any EMS should be viewed through a, you know, within fixed income, a multi-asset approach and, you know, flexibility, as Kevin mentioned.
Does that, Dwayne, over time, so like you talked about the streams for a minute, does it feel like, you know, bringing in streams from every single dealer over time will just get more cumbersome than it's worth, or does that seem like something that will sort of stick with the model for a while?
I mean, there's clearly, you know, plenty of, you know, venues out there now where you can engage with the, you know, the automated marketing making from the various dealers. But where I think the real advantage is, and what I think the dealers would be interested in, is tailoring that delivery of that content to a specific client. So, you know, AQR's process is different than T-Row's, so they might get a different delivery from a dealer than we would get, but it would be highly value added to both firms.
Right. Sure.
Versus a generic automated market price that anybody could see on any platform.
Well, right. It's the advantage of continuous pricing without having to ask for it, but still tailored for you and your relationship with that particular liquidity provider. Absolutely. So Anil, maybe it's a good one for you. So the other thing, when you think about EMSs in the traditional sense, you think about liquidity aggregation as one of the key things that they do. How can that work? In certain fixed income markets like treasuries, you can aggregate order books, but what about non-order book markets? What about aggregating, you know, can you aggregate RFQ markets? Sort of like how can that work in markets that are not order book driven?
Yeah, so I mean, you got to, as these guys pointed out, that first of all, you have to make sure you support all the products and then you support all the protocols. So in many of these markets, they are still manual. There's no streaming prices coming in. You cannot build an order book by default. So what you have to do is you pull in the indicative prices and prices from related markets. Like, you know, some cash treasuries is pretty liquid and swap are pretty liquid. So you pull it from those markets. And then you build a what we call synthetic order book, which is to say that these are the indicative prices. Maybe these are X's that we saw, or these are the composite prices that we saw, or like, you know, related prices that we have. And you build an order book, then you refresh it, meaning they could be stale. So you might do beta adjustment to some of those prices against some liquid indexes or nuke in terms of converts. And so then you have a picture of, like, you know, where could theoretically you trade? Like, you know, like this is where we think liquidity is, and it's across protocols, across these markets, and you have that synthetic market, synthetic order book you create out of related markets.
Right. So it's very much a data exercise, if you will.
Yeah, and like you have to put like, the sort of streams, like some of those could have some streaming. The sizes could be small, but streams could be coming to you. And certainly RFQ is so you have to put it all together, like, next to each other and like be distinct, but still be consumable at the same time.
Sure. So for Dwayne and Jeremy, so for markets like, U.S. corporates, treasuries, even swaps that are mostly RFQ, when you're thinking dealer to client, are you still mostly trading those directly sort of through the venues, or are you starting to find ways to do that directly through your OMS or EMS?
I mean, I can start. Our current process is we were able to place orders from the OMS to the particular venues, and then the orders, the fills come back. So that's one benefit of straight through processing. But I envision the EMS actually kind of aggregating that entire pool of liquidity. So, and a lot of the venues are starting to open up, their platforms to connectivity to the EMS providers. So you can actually aggress on that liquidity directly from the EMS. To me, that's kind of the opportunity set to really increase the value added proposition from the trading desk.
Yeah, I very much agree with that future state vision. We're either doing we're responding mostly or posting RFQs on the traditional the ECNs or the venues that you're referring to, but and doing as much straight through processing as we can, so process trades. But I think in future state, this is another benefit to having an EMS that you can that can be agile over time, is that will continue to actually evolve. And I think with our key partners that we'd expect that to happen.
Yeah, no, that's great. And that you've said in the beginning, right, about sort of the cockpit idea, to really have it be your entryway to the market, which, again, we as fixed income people, we try to not compare to equities because the markets are so different. But if we think from a tech perspective, right, that's sort of where equities went, is a single view into liquidity into the market.
Well, I think also, as an EMS evolves within your own framework, I mean, it can provide some insight into sort of how you allocate your labor, how you approach certain names. Again, it's data, right? I mean, over time, the data will help you make better decisions.
Well, and that's come up a lot so far about the data idea, right? And I guess in my head, or just by what EMS stands for, right? It makes you think about just the trading side, but it sounds like in fixed income, it's much more about the data tools that are built into the EMS. At least as much about the data and the analytics built into the EMS as it is about the execution linkages. Does that sound right? And then it's just sort of same question before about multiple products. Trading corporate bonds and CDS, it's both credit, but the exact data you need and the way you use it would be different. So sort of how we thinking about that, and do you agree? Is data like a huge component of what makes a fixed income EMS?
Yeah, so data and analytics both are a big component of fixed income EMS. One is because it starts early in the process. A fixed income EMS starts from the security selection point of view, like which bond to pick. Like there's a lot of data that goes into it, like how many runs you are getting, how frequently they are getting refreshed, and so on. And so then is the data about dealer relationships, like who are your top dealers? Are they performing? Are they giving you good quotes and in a timely manner? And are those relationships working? And then is the time of trade, like which protocol should I pick? Like if you have a cockpit where you can see, okay, there's streaming is showing me this with small sizes, but then there's opportunity to do RFQ, and these X's are organized in the way of their goodness in data, because the data quality is very important there. Not just data, because you got to weed out some of those X's and all other information that you get. So that's where fixed income EMS has a lot of role in that analytics.
Well, I think also you step back and you just acknowledge there's a lot more data than there used to be. There's a lot higher quality data. The data is becoming more accessible. So depending on an individual's organization, I mean how they where they actually capture and organize this data could be, there's different solutions around that. But one thing's for sure, that the traders are at the bulkhead of where this data is generated, and the traders can also provide a lot of added color. And you're talking about the data comes from electronic networks, the data comes from AX lists, the data comes from just regular interaction with salespeople. So, the question would be, where in an organization, where in the investment process do you really kind of want to like put a pin in it and say, let's organize it around here. For us, we think that the EMS can be an integral part of the solution. It's not the whole solution, but it's an important part of it.
So one of the other, what this sort of brings to mind for me, and I've been, as an analyst, looking at the OMS EMS space since a long time ago, for almost 15 years. And the questions we've been asking since then, we're still asking now, right? Or should the OMS and EMS still be kept separate, or can they be put together? I think in the early days, there were technical reasons why it was hard to put them together. I'm not sure those are all completely true anymore. We just have so much access to compute power and things we didn't have even 5 years ago. But I'd love to hear the sort of both the practitioner view and the sort of the technical view, right? Should the OMSs and EMSs be kept separate? Should they be better integrated? Can they actually be one thing?
I can start. I think of it in terms of desktop interoperability. So, just like your iPhone, you're able to connect different applications. So I think whether they're separate or together, I think the integration between the two are key. So the OMS, as a trader, what you want out of an OMS is you want clean orders. And what I mean by clean orders, you want guidelines checked, you want risk metrics of the security checked, all the details of who you can trade with prior to you going out into the market to execute that order. With an EMS, I think you want, an aggregated view of the entire liquidity picture, of that particular asset class, that particular security, prior trades you've done, dealers that you have success with given a particular order. And I think it's very difficult for one platform to move swiftly with this evolving market structure. I mean, there's no, even the most advanced system is not going to be perfect because the market's, constantly evolving. And, from our, we want to be nimble, we want to be agile, and we want to have scale, and we want to be innovative. And I think, having multiple partners, allows different perspectives to fit our investment process. So that's kind of the way I look at it.
What do you think, Jeremy?
I would agree with that. I think, each organization's a bit different. From us, it comes down to, how much do we want to drill into a particular asset class, and how much do we want, how much flexibility we want to measure things, and because no OMS is going to be able to provide and support all of the nuances that every asset class needs, and without it taking a lot of time with a larger OMS. So for us, it was just it was a question of just we trade a lot of different asset classes. What do we want to do with OTC fixed income, and what gives us the best scale in the future to be able to quickly and relatively quickly adjust to changing market dynamics?
Yeah, that's great. Yeah, it sounds like a lot of it is it's the question today is not about should they be one system, but how easily can you have all the functions integrated with one another, regardless of where you got them from.
Right.
And yeah, from a technical perspective, I mean, as you guys have been building your platform over the last few years, how do you think about that?
Yeah, so I think the labels are a little bit outdated, the OMS, EMS. So what we think is that what a fixed income EMS, you can call it EMS, but it's a trading system. So anything that a trading desk needs to do, should be in that EMS. Technically it could belong in what layer you have, but for most of the traders I know, they don't want to deal with OMS. They don't want it open in their desktop because it's a waste of time. So to them, that is their window, and internally, how does it make it all work? That's the integration part. That work with the OMS underneath. If you have a legacy OMS, sort of cover their issues, And if you don't have, EMSs in fixed income, like do a lot more than a traditional EMS. So it could be, sort of bordering on to being an OMS also.
Sure. Okay. So we've actually gotten a couple of good, we're more than halfway done. We've gotten a couple of good audience questions. I thought maybe I'll inject them now, and then I can sort of go back to our list. So the first one focused on corporate credit markets, corporate bond markets. I'm going to paraphrase a little bit, but it's talking about the sort of the use or usefulness of EMSs trading odd lots versus round lots. And I sort of, if I read between the lines, I'm thinking, this is how e-trading and corporate bonds got started with smaller sizes. Obviously, that's been changing over the last decade. Are you finding, as you're using an EMS in corporate bond markets, are there places where maybe it could be used to help with round lot trading? Does it still feel more like a smaller trade execution tool? Any thoughts there?
I don't really think there's a difference. I mean, I think, if you're pulling in, say, third-party composite pricing, there's, several choices out there. You're going to use that kind of as a reference point, whether, the trade's an odd lot or a round lot. What I do think on round lot trades, because you're capturing a fuller picture of the liquidity, it allows you to be more of a, price decision maker on your engagement. So, giving that portfolio management team, kind of a menu of price options, saying, if you're trying to sell 50 million, maybe 10 million works here, 20 million works here, and we can get the full size done here. On an odd lot, that if you're able to bring those prices in, as streaming levels, then, potentially those odd lot trades aren't even hitting the manual trader's desk. It's really just kind of, workflow that, you're able to aggress against the prices that you have in your system, and you're able to meet your best client outcome objectives by hitting those levels. So I think streamlining, removing those odd lot trades from the trader's day to day, I think is another benefit of that aggregation of liquidity.
Yeah, I think it also it speaks to how you kind of organize where your trader's effort really is, right? I mean, I think from my vantage point, when I think about an EMS, I mean, odd lots and larger trades are all going to be managed from there, basically. So I mean, I think again, you want to have a system that gives you the best window of of all the liquidity that's available, ideally. And where if a trader's time, if a human trader's time is better spent, managing a larger order, the system really you should be able to lean on the system to help with that.
Sure. Yeah. Go ahead, Anil.
Yeah, so like in the block trade sizes, so you might do as Jeremy and Dwayne mentioned, that you might say, like, I'll trade a part of it on the stream, part of it RFQ to some dealers, part of it maybe on the matching venue, but the same, because those are just all the possible liquidity sources you have, and remaining I'm going to leave it as a working order with the dealer. So that's a fine thing to do. Large order EMS helps you in that, because it gives you the like, this is where all the liquidity is, and you can clip it these various ways, and this is where your probability of getting filled is with a different protocol and dealer.
So it's the other thing.
I'm sorry, go ahead, Dwayne.
Well, I was going to say, the other thing about odd lots, they're typically, a pro rata slice of a client's portfolio. So it's not like you can just say, oh, it's just an odd lot trade. But if you go back to the March volatility, odd lots were actually harder to trade than some of the round lots, just given, the velocity of the price changes and, the, ability of people to focus on, bigger blocks of risk. So I think the EMS, kind of bridges that gap to not separating those two trades, but making one more efficient and then freeing up a trader's time to engage on a higher value added trade.
That makes sense. Yeah, it's about the technology, but also refocusing the trader's time where it's most needed. That's great. So one of the other questions, and this sort of comes back to the buy versus build conversation we had earlier. If we're thinking about using an EMS as a data aggregator, data analytics platform, sort of how do you differentiate if you are using, in theory, the same data and analytics as another firm, right? If you're buying. which again, a little bit of an age-old question, but I guess sort of framed in a modern way.
Yeah, no, I could take it, or Jeremy, you want to take it?
Go ahead, Anil.
Yeah, so I mean, the buy versus build is interesting. I think it's for me, like I spend most of my time on the buy side, my career, and I had to, sort of make that call many times. And what it comes down to is that, in the basics of buy versus build, and then I'll address the, how do you differentiate if you're using the same data. So it comes down to, build is very expensive and like it's going to take a long time, but buy is also not very straightforward because most of the vendors in our space have sort of diluted this their credibility. So like because it takes years to go live and like half the times they don't work, and so there is a serious discussion to be had there in buy versus build. But when it comes to like how do you differentiate if you're dealing with the same data? So I think the question is like you're not doing a buy versus build, you're picking a partner, somebody who's going to be agile, who's going to be focused on the problem, and who's going to be focused on the market segment. Meaning like there are like EMSs that could say like, oh, we work for buy side, sell side, market maker, and broker dealers. I don't know how you can serve so many people and serve them well. So you got to have a partner who's focused on your market, on the in terms of like buy side, sell side difference, and that you care about, which is the fixed income, and have the agility, and then we'll come to that if you have such a partner, then they would be able to pull a lot more data, pull it more intelligently, clean it more intelligently, analyze it, weed out the nonsense, and like then you have the actionable data.
Yeah, I mean, and I think right. I think that's the other part that's come along with the technology over the last 20 years, right? It's customizable, and you're providing a solution, but in some ways you're more providing tools, and then it depends on what data gets taken in and what you decide to do with it, right? And that's not just EMSs, that's all sorts of sort of I don't know, investment analytics, trade analytics tools. We'll take that as a good segue, actually. So let's talk about what are some of I'd love to hear some of the cool sort of new stuff happening within these trading platforms, whether OMS or EMS. We've talked a bit about obviously sort of managing protocols and different styles of execution, data analytics. So what's been new and interesting for you? If we think there's pre-trade, there's post-trade, TCA, best X, new ways of using data, alternative data usage, maybe what sort of sticks out in your mind as some of the sort of the cooler, newer stuff over the last year or so?
Well, from my vantage point, I think one of the most interesting developments is really the ability or the interest with the key partners on the sell side to actually spend the time and putting together bilateral connectivity and thinking about what the right trading protocols would be. And I mean, clearly there's an interest for both sides to actually make the transfer of information and particularly valuable information for both partners to be much more efficient. And so that's actually something that I think's been evolving quickly, and I think that's going to drive a lot more efficiency in the future. And it speaks again to the need for, I think, a very very robust EMS that can hook in quickly.
Yeah, I mean, I'd echo that. I think the willingness of the various market participants, whether it's dealers, vendors, buy side, open to working together to kind of solve solutions and to get better access to a higher quality level of data, and that's where I think the flexibility of an EMS comes into play, because dealers don't want to have to connect to have 100 different separate fixed connections to the buy side, nor does the buy side want to manage 100 different fixed connections. So that kind of connectivity vehicle, and obviously data integrity, quality, protection are very important to both dealers and the buy side. So being able to have those direct pipes and that connectivity I think is important going forward.
Do you think?
I think one other thing I just wanted to add, we talk so much about data, and we talk so much about making things very efficient, which is all very key and important, and everybody's interested in that. But at the end of the day, it's also about targeting our traders' ability to really focus on the high value risk transfers, right? And so just because we're trying to increase bilateral connectivity and trade more electronically, the reason for doing this is because we view, and as a firm, there to be real edge in the traditional voice traded block situations, helping and working with our counterparties to price risk, them pricing risk for us or us pricing risk for them. That over the past several years, I think, has been a little diluted by a lot of sort of the inefficiencies in the product, such as the amount of time it takes to do pre-trade analytics on really small trades that can be priced by an algo, and they can be traded in STP with little or no human touch. So really it's important to create these efficiencies and to move as much that makes sense electronically. But for us, and I think I would speak for people as well on the sell side, it's also about augmenting the value add that these high touch risk transfers actually have for client returns.
Yeah, I think it's something we've talked about a lot this year, sort of like despite our mild obsession with electronification and technology, right? How important relationships are, and in many cases the technology is not trying to replace the relationships. To your point, right? It's trying to augment it. It's trying to make it better and more efficient for both sides. Do you think the fact that everybody's working from home now has maybe accelerated some of these trends, right? Made the connectivity even more important, or was it coming anyway, and it's sort of just a natural progression?
I think way, but go ahead, Dwayne. Sorry.
Well, no, I was just going to say, I think it's certainly back to the data question. It's highlighted the need to share data for sure, but I also think it's kind of elevated the profile of a desk in terms of the market volatility was so extreme back in March, and then the rally, there were still discrete liquidity opportunities. So I mean the desk really had to be connected with the investment process, and I think even though in office, there was a lot of connectivity, but I think you heard from, at least from my perspective, hearing from, a more diverse set of voices that could chime in on a, symphony or, a Zoom video chat and, show what they were seeing, on their screens, I think, highlights the need, to develop systems internally that meet those objectives.
Well, the face of webinars is forever changed. No more slides.
True.
So actually, I'm gonna divert for a second because we got a question in that sort of goes back to when we talked before about the allocations, right? And you talked a bit about sort of doing those allocations pre and post trade. Somebody specifically is asking sort of how is that being done, right? How are the allocations getting back to the dealers? Is it an automated flow from the EMS? Is it electronics, or what's that workflow look like?
Yeah, so it is an automated flow and it goes electronically, and most dealers are able to take it electronically nowadays. Yeah, so you want to trade the block and you want to do affirmation at the block level, so either through RFQ or one of those methods, and then you do want to allocate it down to the fund level because that's where they're going to be booked. And it gets it's simple in case of corporate bonds. It's not too hard because it's just the settlement amounts have to be calculated. But when you get into the multi-leg trades, like more on the rate side, let's say you're doing a swap, it's a 50-leg swap, meaning you're rolling a swap that you did, 50 coupons over time. And when you do that, and then you have to send allocation of each leg, that is an involved process. And that's where EMS plays a good role, because a dealer would quote you a present value of the whole swap. They'll say $2 million for the whole package of 50 legs, and I'll roll it to the next 5 year. Now you got to take that, and some of those could be, they're all different coupons. Some of them are pay fixed, receive fixed. So you got to allocate it that way and then send it.
Okay, very good, thanks.
I'd say the way I kind of think of it as from an asset manager is we have both pre and post trade compliance. So we envision our orders, that's where the integration between the OMS and the EMS is key. So the orders are still going to get generated in an OMS. The trader takes the orders, uses the EMS to assess the liquidity opportunities. Then post execution, those orders would then be passed back to the EMs to make sure that they, pass all the post-trade compliance checks that we have to do, for all the different accounts that we manage for. So, I mean, that's where the integration, I think, is key to the allocation as well.
Sure, streamline a complicated process. Great, so we're just about out of time. I'll ask one more question and then we'll wrap it up. Obviously, for Jeremy and Dwayne, like running a trading desk is no easy feat. So many challenges. Be curious sort of what your biggest challenges are today, where you're focused. I don't know if work from home still a challenge, or are we sort of over that and we figured it out now? There's multi-asset trading. There's obviously always regulation, access to data. So what are some of the big things on your mind as we sort of look to the end of the year? I don't know, Dwayne, why don't we start with you?
I mean, work from home has actually been, a pretty seamless transition. Trading has historically never had that opportunity to kind of work from home. I think the challenges are, for maybe some of the younger traders, they miss some of that, senior level engagement and perspective. I'm less in the camp that this buzz of the trading desk, because most of the stuff is IB anyway. So I don't think, most desks are pretty quiet these days, but I think there's going to be a combination. This is my own, I'm not speaking for T-Rowe. This is Dwayne Middleton's view. I think there's going to be a hybrid model of, in office and flexibility to, make the, work-life balance better for the trader. And as well as I think it helps with, diversity and inclusion efforts as well in this particular seat. So I'm excited what the future holds for the trading seat and, kind of that hybrid model.
That's awesome.
Yeah, I mean, historically, to Dwayne's point, it was hard to imagine this happening, but I think we've been really impressed by how kind of how the technology supported us. The first couple months, we were in very volatile times, and so the focus was really just managing risks, making sure they're we're transferring risk properly and things are getting booked properly, and we're minimizing operational risk. But look, there's busy days and there's less busy days for traders, and we've always been, my desk, my firm, we always try to ensure that when traders aren't executing, there's traction around projects and things that keep people's head in the game, and so one of the things that I think would be a debate is, can you keep the tempo up on those, those longer term projects that you're trying to develop? And I've been pretty impressed that we have. I think we all have, to some extent, maybe a little bit of Zoom video fatigue, but we've so far done it. I think the longer term debate will be there around whether there is actually sort of, some type of a degradation of that, of being able to do that. But that's what comes to mind for me. The day-to-day functional trading has been really, really robust, and we've seen very volatile periods and we've seen quieter periods in this past 6 to 7 months. So I've been impressed, but I think the debate, it's to be determined.
That's great. Yeah, I mean, if we didn't all learn to never say never back in 2008, we certainly learned it now. It's amazing, and yeah, hopefully this will bring some more work-life balance to Wall Street, as much as that can be possible. All right, great. Well, with that, I think we'll wrap it up. Thanks, Jeremy, Dwayne, and Neil. Awesome conversation. Thanks, everybody, for listening in. Please do click on that survey when you log out. We'd love to hear what you think. And with that, we'll wrap it. Thanks so much, guys. Great conversation. Looking forward to the next one.
Thanks a lot.
Thanks, everybody.
All right. Have a great one.